Annuity payout rates and interest rates are often confused or conflated. They're both percentages, but they describe different relationships. In this video, I want to do two things. Firstly, I'm going to sketch the basic difference between the payout rate and the interest rate, give a few examples, and then secondly, I want to say a little bit more about the context in which these things are often confused, namely in sales presentations for annuities. The first part is going to be a little bit less involved, and if you're here just to get a basic sense on how payout rates and interest rates are different, then that information is going to be found in the first few minutes. And if you're here for a broader conversation of the context, then I invite you to stick around all the way to the end. So firstly, let me lay out some of the basic differences. In this context, payout rates are going to arise in conversations about annuities. And the payout rate, intuitively enough, is going to have something to do with the annuity's payout. Of course, the payout here is the amount you receive from the annuity once the annuity has been settled. And that's a point we're going to come back to repeatedly. So the annual payout amount, or the amount that you get in terms of a settled income stream from your annuity, is part of the calculation that goes into the payout rate. The other part is the amount that you had to pay in at the time the annuity was settled. It's the amount of money you had to give up ownership interest in order to secure the annuity income stream. Annuities are complex. The easiest kind of an annuity to consider in terms of getting a handle on what the payout rate is going to be a single premium immediate annuity. The reason that this kind of an annuity, called a SPIA, is the easiest to use for this illustration is that the amount you had to pay in is simply the premium that you were charged for the SPIA. Now this differs from a deferred annuity because with a deferred annuity, you might have paid premium in over a period of time, and so the total premium outlay is going to have to be factored in, as well as your investment experience with that annuity. So if you had gain, that will be factored in, and if you had a loss, that will be taken off. So let's give a concrete illustration, and we'll consider a single premium immediate annuity paying out $6,000 a year. Let's suppose you bought the SPIA for $100,000 of premium. Well, then your payout rate is a simple division problem. The numerator is going to be $6,000 of annual payout divided by $100,000 of premium, and of course that gives you a 0.06 payout rate, or 6%. Now before we go anywhere else with the conversation, let's compare that to the interest rate. Interest rates are generally more familiar to people, so we can probably move more quickly through this example. Now an interest rate expresses a ratio between the amount that you earn annually and the principal. That is, the amount that you have deposited or invested. Let's take an easy example. Suppose you have $100,000 in a certificate of deposit, or a CD. Let's suppose you're being paid $1,000 of simple interest every year. Current interest rate averages are abysmally low. They're going to be far lower than 1%. This is just to make the math easy. So again, it's simply a division problem. You take $1,000 of interest in the numerator and divide that by $100,000, which is what you have on deposit. And when you perform that division operation, you get 0.01. or 1% interest rate. So payout rates and interest rates are formally similar. Both of them were division problems, and in some sense, those division problems had structural similarities as well. The numerators, for example, were both comprised of money that you get in some way, and in both cases, the denominator was composed of a number that you had to, in some sense, put in. However, that's where the similarities end, because obviously the mechanics of what it is to get money out of an annuity that's been annuitized and to get money out of a CD through interest are very different, and the mechanism for putting money into an annuity and then annuitizing it is very different from the mechanism of depositing money into a CD. So consider a possible situation. Let's say you're in the process of debating whether to put $100,000 into a CD or to keep $100,000 in a CD you have already versus to take that same $100,000 and purchase a SPIA. And let's suppose that these instruments have the numbers that we just went through. So the SPIA is paying out 6% and the CD is paying you 1% of interest annually. Is the comparison as easy as simply saying, well, 6% is bigger than 1%? End of story. And the answer is no, it is not that easy. And if any salesperson tells you that it is that easy, you should run away as fast as you can. Because simply put, the payout rate should not be mistaken for an interest rate. And there's a number of reasons for this. Number one, the CD's interest rate is measuring what is typically referred to as a rate of return. To get a fix on this, let's use some really loose and non-technical language, and let's borrow a few illustrations, number one, from the world of business. So think of the $100,000 in your CD as if you had a little business that was valued at $100,000 and every year you made $1,000 of profit. So consider your interest earnings as being profit made by your little CD business. Or if you don't like that analogy, consider one from real estate. Suppose you have a property worth $100,000 and suppose you have the option to rent it for $1,000 a year. In both cases, you own some asset worth $100,000 and that asset is earning you additional money on top of the value of the asset. So again, with your CD, you have $100,000 in there, you have ownership of that, and at the same time, every year you're collecting an additional $1,000. When the CD matures, you could take your $100,000 back out, say thank you very much for all those interest payments, and do something else with your money. And this is similar to how you could sell your business at the end of the year, or you could sell your property after one renter moves out, or you could rent it to somebody else, or you could move into it yourself. The property is yours, and in the same way with the CD, the $100,000 belongs to you. But purchasing an annuity is very different from depositing money into a CD, at least once you annuitize the annuity. So if you have $100,000 going into an annuity and you intend to settle it, which is again what occurs automatically with a single premium immediate annuity, then this is probably better thought of as a purchase in a more traditional sense. If I give you $1 and you give me a widget in return, then I no longer have an interest in the $1 and you no longer have an interest in the widget after the transaction is complete. In a similar way, if you purchase a SPIA from an insurance company, then the $100,000 that you had before the purchase no longer belongs to you after the purchase is over. What you get instead is a steady stream of income from the insurance company every year for the rest of your life. In other words, the annuity enables you to trade an asset for an income stream. It enables you to buy a stream of income for yourself, and this is one reason why an annuity is sometimes referred to as being able to purchase a pension for yourself. Now, I've gone into the similarities and differences of annuities and pensions in another place, but for present purposes, this is the crucial point. With most purchases, once you've paid the money for whatever item you're buying, that money you paid is no longer yours, and it's the same thing here. Once you put money into an annuity and settle the annuity, that money is no longer yours. What you have instead is the income stream that the annuity is producing for you. Now let's talk about some takeaways from this discussion. I'm going to suggest that simply outlining the basic facts about how a CD functions, how an annuity functions, the basic mechanics of how to calculate a payout rate versus an interest rate, that these basic facts don't determine what you should do with your money. It might be easier to see this if I use an example from real estate. So let's say, as we alluded to earlier, that you do have a property worth $100,000, and let's say that you could rent that for $1,000 a year. On the other hand, you could also sell it. Now, the mere fact that in selling your property, you divest yourself of interest in the property isn't in and of itself a reason not to sell the property. That's simply what selling means. When you sell something, you give up your ownership interest in the thing you're selling. In a similar way, rather than to think of buying an annuity, it might be helpful to think rather that you're selling the asset that you used to fund the annuity. So for example, with the $100,000, what would you accept as a fair price for your $100,000? Would you accept $6,000 a year for the rest of your life? And if you would, maybe an annuity is a good purchase for you. If you wouldn't, then an annuity probably is not a good purchase for you. Now, of course, there's much more to it than this. It's going to depend on lots of personal factors, including your risk tolerances, your longevity projections, and no decision really should be made without you consulting a trusted advisor. This video, of course, is for general informational or entertainment purposes only and should not be construed as specific advice. My point here is simply to say that in selling a property, you give up ownership interest, but that mere fact doesn't, in and of itself, determine whether selling a property is a good idea for you or not. Number two, annuities are tricky. In my example, I used a single premium immediate annuity because that kind of an annuity kind of mitigates or reduces some of the confusion. Not all, but a little bit. One way of getting a fix on how tricky annuities can be is to consider that even though all annuities can be annuitized or settled, that's just what an annuity is, it's a vehicle that can be annuitized, not all annuities are annuitized or settled. So a single premium immediate annuity is an annuity that is always annuitized because you wouldn't be putting money into it if you didn't want to annuitize it. So it's automatic. But for other annuities, usually called deferred annuities, there are sometimes what are referred to as two phases. The first phase is called the pay-in phase, and the second phase is the payout phase. Now, when you are funding the annuity, you're in the pay-in phase, and the money that you put into the annuity in that phase belongs to you. You can put money in, and you can take money out. But if you take money out, it's under the auspices of a withdrawal. Now, you may be subject to surrender charges and other fees for accessing the money, but in principle, the money belongs to you in the pay-in phase. Things are very different in the payout phase. In the payout phase, money you get from the annuity is not a withdrawal. It is simply the insurance company honoring its portion of the agreement to pay you a lifetime stream of income. And of course, some annuities may not pay a lifetime stream of income, but once again, we'll ignore that complexity and simply focus on lifetime annuities. Now, that is a big change. It's probably the most fundamental change that you should understand about the two periods of the annuity. In the pay-in period, the premium money belongs to you, and in the payout period, the money has changed hands and now belongs to the insurance company. And the transition between the pay-in period and the payout period is referred to variously as annuitization or settlement. This is when the money changes hands. Instead of belonging to the individual, it now belongs to the insurance company. Obviously, this marks a big difference because with a CD, for example, the money you have put in will be returned to you. Your principal will be returned to you when the CD matures. Whereas when you have money in an annuity, once you've annuitized the annuity, those premium dollars no longer belong to you. They cannot be accessed. They cannot be withdrawn from. Now they simply belong to the insurance company. But to complicate matters even further, number 3, when an annuity is in its pay-in period, if the annuity is of a particular kind, for example, fixed annuities, there may actually be an interest rate that is applied during the pay-in period. Now, if you have this kind of an annuity, a deferred fixed annuity, then the interest rate will be applied very much the same way as it would be in a CD. So, for example, if you have a deferred fixed annuity paying 1% and somebody else has a CD paying 1%, then the interest calculation is going to be very, very similar, and the interest rates are going to be roughly comparable. Now, that doesn't mean that there are no other considerations that should go into a decision about investing money into a CD versus an annuity. The annuity is going to have some kind of a surrender period during which surrender charges are going to be applicable. This is roughly comparable to the period of time that the CD takes to mature. So if you have your money in a 5-year CD, in theory, you'll be penalized for any withdrawal before the 5 years are up. But with an annuity, the surrender period might be 7 years, 8 years, 10 years, or more. In addition to that, of course, you always have to be on the lookout for teaser rates or other kinds of variable rates, rates that are going to reset after a period of time. So if you are trying to compare a CD, let's say, to a pay-in period annuity, you're going to want to know not just what the interest rate is now, but what is the interest rate guaranteed to be, and how often does it switch. Now, you'll also recall that in my crude example, I supposed that the CD was paying simple interest, and of course, many CDs and annuities are going to pay compound interest instead. In addition to that, some CDs and annuities also have tax qualifications, and this means you may be eligible for tax-deferred growth in addition to compound interest. Now, I told you this was tricky. Number 4, given all of this complexity, I will say again, if somebody tries to tell you that the matter is simple or the matter is easy, or they try to dazzle you with different percentages, run away as fast as you can. Now, this is certainly not to say that all salespeople are sleazy, and in addition to that, it's not to say that only insurance salesmen can be sleazy, and I'm sure there's any number of bank representatives who may try to get you involved in a CD without being honest or upfront about teaser rates and other kinds of caveats. We all remember Wells Fargo creating fictitious accounts for people. The simple takeaway from this video is that payout rates and interest rates should not be mistaken for one another. They are very different. And to put it crassly, a payout rate of 6% is not 6 times more powerful than an interest rate of 1%. They're simply incomparable. But fifthly and finally, I do want to reiterate that the bare fact that with an annuity you give up ownership interest in the premium dollars once you annuitize isn't by itself a reason to disfavor annuities. If you disfavor an annuity, it should be for very personal reasons. It should be because of your risk tolerance. It should be because of your longevity estimates. It should be because it doesn't fit into your portfolio. So ultimately, what fits or what does not fit into your portfolio is going to be a very personal matter. And once again, in order to determine what is a good fit for you, you should consult with experts in your area, people that you can disclose very personal information to so that they can help you come to the best decision possible. So in summary, a payout rate expresses a ratio between the amount the annuity pays out to you in annuitized income and the amount of premium you had to pay in. whereas an interest rate expresses a relationship between the amount of money you earn every year against whatever principal you have on deposit. It's wrong to think of the payout rate as a rate of return, and it's also, I think, mistaken to think that the fact that you retain ownership in something like a CD automatically means that that's a reason to prefer it over an annuity. I think mistaking the payout rate and the interest rate also kind of leads one to believe that rates of return are the only conversation worth having. But I'll point out a statement made by the white coat investor, and he is normally fairly down on insurance products and insurance salespeople generally. But here's what he writes. In an article titled SPIA, The Good Annuity from 2012, he says, quote, "A high return isn't the point of these things. The point is that the return is guaranteed." Now, I've tried to be non-technical here wherever possible in my explanation of the payout rate versus the interest rate, but there's much more that can be said. There are more intricate conversations that might involve things like the internal rate of return. It's also worth pointing out that annuities do actually have rates of return. It's just more complicated to calculate them because you actually have to know how long the annuity is going to be paying out. So your life expectancy has to be factored in, and for people who are still living, that's going to be a speculation or a projection. I've also ignored quite a lot, particularly with respect to annuities, which can have different payout periods. But if you found something of interest in this video, I ask that you like the video, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you so much.